Hey everyone, have you ever just stared at your chart, completely lost, wondering what on earth the market is trying to do? If that sounds familiar, you're in the right place. Today, we're diving into something called multi-time frame analysis. Trust me, this is the key to getting a huge edge because it teaches you to see what the market is really doing and to ignore all that distracting noise.
So, let me just ask you this. Do you ever feel like your trading chart is straight up lying to you? It really can feel that way, can't it? You spot what looks like a perfect setup, you jump into the trade, and then bam, the market completely reverses on you. That frustration, it usually comes from looking at just one tiny piece of a much bigger puzzle.
And this right here, this says it all. Over on the left, you've got a 5-minute chart. It's a total mess, right? It's chaotic, it's confusing, it's just what we call market noise. It's basically a minefield of bad signals. But now look at the daily chart of the exact same asset on the right. Whoa. Suddenly, everything is crystal clear. You see the bigger picture, the real dominant trend. This is the exact problem that multi-time frame analysis is designed to solve.
So this brings us to the big aha moment. It's all about seeing the bigger picture. We have to stop looking at the market through a tiny little keyhole. Instead, we need to open the blinds and look through a massive panoramic window. And the way we do that is by looking at multiple time frames together. So what is multi-time frame analysis, or MTA, anyway? It's actually pretty simple. It's just the process of looking at the same stock or currency or whatever you trade across a few different charts at once. You know, like looking at the daily, the 1-hour, and the 15-minute chart all together. When you layer them like this, you get so much more context. It helps you separate the junk, the meaningless noise, from the actual trend that you should be trading with.
Now, to really get this down, there are 3 principles you've got to know. The first one is a biggie: hierarchy. The simplest way to think about it is this: the higher time frames are the boss. The daily chart, the weekly chart, they just carry more weight because they represent more time, more money, and more decisions. They set the stage. They are your strategic map, telling you which way the river is flowing. Okay, so if the higher time frame is our map, then our second principle, confluence, is where the magic really happens. This is all about getting everything to line up. It's when your daily chart is screaming, buy, and your 1-hour chart is showing a perfect bullish setup, and your 15-minute chart gives you that perfect little trigger to get in. That's confluence. When all those signals align, the odds of your trade working out just shoot through the roof. It's the ultimate confirmation.
And that idea leads us straight into our third principle, filtering. I want you to think of your higher time frame as the bouncer at the club for your trading account. Its only job is to keep the bad trades out. So if the weekly chart is in a massive downtrend, this principle tells you to just flat out ignore any little buy signal you see on a smaller chart. It's there to protect you from fighting the main trend, which is a battle you'll almost always lose.
You know, this source material had a perfect way to put this. It says, disregarding the higher time frame trend is akin to sailing against a strong current. And it's so true. You might make a tiny bit of progress here and there, but you're working so hard, fighting this massive force the entire time. The smart money, the easy money, it's made by sailing with the current.
Okay, so that's all the theory, that's the why. Let's switch gears now and get into the how. Let's talk about a practical framework you can actually use, which we'll call the 3-lens method.
It's a super simple top-down approach. You always start with your higher time frame, or HTF. That's your map. Its job is to tell you the main trend and point out the major support and resistance zones. Next, you zoom in a bit to your intermediate time frame, or ITF. This is your compass. You use it to find specific setups, like a nice pullback that are moving in the same direction as your map. And finally, you pull out your lower time frame, or LTF. This is your magnifying glass, and you use it to find a precise, low-risk spot to get in or out. And what's really cool is that this framework isn't rigid. It adapts to whatever your personal trading style is. Just take a look at this table. Whether you're a scalper or a long-term position trader, the logic of map, compass, and magnifying glass stays the same. Just the charts you use will change. So, for example, if you're a swing trader, your map might be the daily chart, your compass the 1-hour, and your magnifying glass the 15-minute. A good rule of thumb is to keep about a 4 or 5 to 1 ratio between your different frames.
All right, let's make this even more real. Let's walk through a classic, high-probability setup so you can see exactly how all these pieces fit together when the market's moving.
Okay, here's a textbook play. Step 1, we're on our map, the daily chart. We see a beautiful, clear uptrend, and we mark off a key support level. Simple enough. Step 2, we switch over to our compass, the 1-hour chart. Now, we don't just jump in. We wait. We patiently wait for the price to pull back and come down to test our level.
And then, and only then, do we move to step 3. We pull out our magnifying glass, the 15-minute chart, and we wait for a clear sign, like a bullish reversal candle. And that becomes our low-risk entry trigger. See how each time frame has its own specific job?
Now, this strategy is incredibly powerful, but here are the common ways people mess it up. The number one absolute biggest mistake is just ignoring the higher time frame trend. You can't do it. The HTF is boss. Another pitfall is analysis paralysis. Trying to use 5, 6, 7 different time frames, just stick to 3, it's plenty. And finally, don't mistake a tiny dip on your 1-minute chart for some kind of major trend reversal. The bottom line, the key takeaway here, is to always let the higher time frame dictate which direction you're trading.
So at the end of the day, it really all comes down to this one question. By learning to use multiple time frames, you stop being a trader who just reacts to every little blip and wiggle on the screen, and you become someone who truly analyzes the market's structure. So the question you have to ask yourself is this: are you analyzing the market, or are you just reacting to the noise?